Hello, everyone. In the next three chapters, 13, 14, and 15, we're learning to close the accounting cycle for merchandise companies. You will recognize that we're doing a lot of the very same things that we did for service companies in the first few modules. However, we're adding the specific requirements for companies that have to keep track and record merchandise inventory. As a reminder, inventory are products purchased for the purpose of resale to gain a profit. You're asked to complete these three chapters in one swoop, so gear up for a very busy week. But rest assured, you will find that not all the concepts are brand new. They all look pretty familiar to you. In chapter 13, we will discuss on how we keep track of and record the inventory using one of the two possible tracking systems, periodic or perpetual. And because it is for most companies impossible to actually track each individual items of product unless you are selling a car or something like that, we will also learn a couple of approaches on how to estimate the ending inventory, and thereby we can finish the financial statement. So here I am. We'll start on chapter 13. I'm going to share screen. Chapter 13, Accounting for Merchandise Inventory. First objective is to understand the impact of merchandise inventory on financial statements. If we made mistakes on the ending inventory, errors will occur not just in one account, but in the income statement, statement of owner's equity, balance sheet. And here are the effects of inventory error. If the ending inventory is understated, then cost of goods sold will be overstated, net income understated, capital understated, assets understated. Overstating an ending inventory will actually create the cost of goods sold to be understated, net income overstated, capital overstated, and assets overstated. Let's see how it is being illustrated in the next graph. As you can see, on the first column, you actually have the correct ending inventory. So you can compare the correct one with the understated one and the overstated one. Understating the ending inventory has the following effects. You can see that the cost of goods sold overstated. The correct one should be 60 minus 20, so equals to 40. But then when we understate it, we see that it's 60 minus 15, therefore is 45. So you can see the cost of goods sold is overstated. The net income is understated. 30 is correct, but here it is. If we made a mistake understating the ending inventory, it will be 25. Capital again is understated. Instead of 30, which is the accurate number, it is showing of a 25. Therefore, understated should be 130. The correct one should be 130, but now it's showing 125. Assets will also be understated because inventory should actually be 20. But now you can see that it is actually 15. On the other hand, if we overstate the ending inventory, we also have a very negative effect of the entire worksheet. Cost of goods sold understated. The correct one should be 60 minus 20 equals to 40. But now you can see that If it's overstating the ending inventory, you see is 60 minus 25, therefore it's 35. Net income is overstated. The correct number should be 30, but now you can see that it's 35. Capital overstated. Instead of adding 30, I added 35. Therefore, overstated should be 130. That's the correct, but now is 135. Assets is also overstated because the inventory should be 20, but now, yes. Assets is overstated. Inventory should be 20, but now you can see that it's showing is 25. Given the importance of the ending inventory, therefore, it is very important on how to make an accurate data entry and also an accurate calculations. In this chapter, you will learn two principal systems of accounting for merchandise inventory, the periodic and the perpetual system. The periodic inventory system is basically doing it at the end of the accounting period. So you won't do it until at the end of the year. So you actually will physically count what's the ending inventory and then do the rest of the adjustment. Perpetual inventory is that you record current inventory. So it's constantly updated. Here it is that you can see the comparison of the periodic and the perpetual system. You can see the periodic system is that you typically do not enter into the merchandise inventory. You actually, from purchase, you enter into account payable. For freight-in is cash. Account receivable, you enter into sales. Account payable, purchases and return and allowance. Sales, returns and allowances, account receivable. So you're dealing in more indirectly. But on perpetual system is that you use the merchandise inventory constantly. You can see that when you buy something, instead of showing purchases, you can see purchase inventory and then the account payable. When there's a freight in, you add it to merchandise inventory. When you sold something, there's account receivable. Then you put account receivable and sales, but also you update the cost of goods sold and merchandise inventory. When the merchandise is cost, then you put account payable and the merchandise inventory. Sales, returns, and allowance is the same thing. You handle the cost of goods sold throughout the year. Computing the cost allocated to the ending inventory and cost of goods sold using different inventory methods. These are a few key concepts that you should know. The purpose of a physical inventory, specific calculation used under the periodic and perpetual system, and the role of lower of cost or market rule. We will go through this one after another. Let's look into taking a physical inventory. This is basically counting the goods on hand at the end of the period time. So for periodic system, you will allocate the merchandise cost between the sold and the unsold goods. So therefore you will be counting the physical inventory currently owned at the end of the accounting period. For perpetual system, you compare to the accounting record to determine if the amount of merchandise actually held agrees with what is reported. Typically, it's done after regular business hours, and some companies even close for a few days to take the inventory. The ideal time will be when it is the business is the lowest season, and that's why the fiscal year will tend to coincide with the lowest level of what we call the natural business year. This is an inventory sheet. It shows table lamp. There are 20 of them. Each of them costs, unit costs how much, and that's a total. So there are wall racks, bookcase, and table, and then desk, and then in total how much there are in total for the inventory. Physical inventory, special considerations. Now there are certain things is that we cannot count as inventory. First is that when it is something consigned to the company, when it's consigned, it really means that the company is selling something on behalf of other. So therefore the goods don't belong to them. Therefore, what they have is not part of what they have, their inventory. The second situation is that when goods in transit, shipped FOB shipping point, the buyers pay for the shipping, the goods belong to the buyer when shipped. So once you accept the goods, then it belongs to the companies. But before that, it still belongs to the seller. So it's shipped FOB destination, the seller pays for shipping, the goods belong to the seller until received by the buyer. So we have to know exactly when the ownership was passed. And inventory do not count any merchandise that don't belong to the company. Let's look into the inventory cost components. So when we looked into cost, it's not just the cost of that merchandise, but it also involves the necessary and reasonable costs incurred in order to get the merchandise to the buyer's place. Cost companies of inventory can include, number one, your purchase price. Number two, your freighting, how much it costs to deliver. Then also your insurance. And sometimes if there are storage fees involved, storage fees is included as well. Computing costs of inventory. Identical items are purchased at different times and at different costs per unit. Sometimes when you buy the same unit, but the price change, it may go up, may come down. Typically, most of the situation is going up. For example, this company in June bought a unit for $25 per unit, but by September, the same unit, which is identical, but it may cost $26.50, so it's more expensive. Of the goods available for sale, then how can we decide which units to apply as the ending inventory? Here we are, you're going to learn 4 inventory methods generally accepted. First is the specific identification. Second, first in, first out, or FIFO. Weighted average. Last in, first out, LIFO. Methods can be applied under periodic or perpetual inventory system. Let's look into the specific identification. Now, not all companies can use this method. To use specific identification, inventory must be physically different from each other. For example, work of art or other things that you can see that you can distinguish them from item A to item B. Or it can have serial numbers, computers, or cars. So cost is determined from the supplier's invoice. So we have to track back when we bought this item, how much it cost. Usually practical only for business in which sales volume is relatively low and inventory unit value is relatively high. So here is an example, inventory costing example data. Let's say that we're selling, the inventory is color printer. You can see that when the start of the period, there are 40 units left in inventory and it was bought at $62 per unit. So that would be the total cost of this batch. But then later on, you bought in another batch, 60 of them, but this one costs $65 each. So the $3,900 is the total cost. The second purchase involved buying 80 more printers. The unit cost is now 67. So therefore it comes 5,360 because 80 times 67 is 5,360. The third purchase is 70 printers and the unit price is 68, even more expensive. So 70 times 68 is 4,760. So here it is, it shows that when we add up 40, 60, 80, 70, it comes to 250. At the same time, is that if we add up all the total cost, the batch of computers is worth $16,500. Now, at the end of the period, there are 50, they count the printers, there are 50 printers remaining. So therefore, you can see the number of units sold during the time is 200. Computing cost of goods sold under specific identification. So we use this method and then we'll calculate it under the specific identification method. The identity of the 200 printers sold are as follows: 30 of the beginning inventory, 50 first purchase, 60 second purchase, 60 and the third purchase, and total cost of goods sold, the 200 printers. So here you can see that here is beginning inventory purchases. You can see items, what are they? Then you have the ending inventory here. And then with the ending inventory, then we'll be able to calculate the cost of goods sold. So let's see, in the beginning, we have 10 units because you know exactly which items are left behind with the serial number or they look different. We know that there are 10 units. Each of these units was worth $62, so it's now 620. There's another 10 units from the 65 unit batch left, so there's 650. There are 20 units and then 67, it costs 67. So now the total is 1,340. And there are 10 left for this model and it costs $68 per unit. So the total is 680. So after we do this, we add them all up. We know that with the 50 end of inventory, it costs $32.90. So now that we know that there are 3,290 as ending inventory, we take that minus from the cost of goods sold available for sale, and that will become the cost of goods sold. Now do note the relationship of the cost of goods sold, ending inventory, and the relationship of the cost of goods sold available for sale, ending inventory, and the cost of goods sold. So how much we start that we have for sale and how much we have left behind. And if we minus the two, then we'll get the cost of goods sold. And here is the same thing, is that now we have the cost of goods sold available for sale. But if we minus the cost of goods sold, then we will have an ending inventory here. So this is under the specific identification method. Second method we will learn is called the first in, first out, FIFO. Assumes that the first goods purchased were the first goods sold. Therefore, the latest goods purchased remain in inventory. Whenever possible, a business will attempt to sell the older goods first before they become obsolete. Grocery stores, bakeries, even computer dealers use this method, and FIFO often follows the flow, the movement of the goods. FIFO inventory method. So here it is. The scenario is the same. We have 40, 60, 80, 20. These are cost of goods sold. These are the price. and these are the total costs, and these are the cost of goods sold here. We know that that 50 is the ending inventory. So when we know that that 50, we will basically take the last price, the unit price, which is the most expensive one, 68, and make it, assuming that they're all cost $68. So the ending inventory is 3,400 total. So with that, we took the cost of goods sold available for sale, 16,500, minus the ending inventory, and that becomes your cost of goods sold. So you can see that it's actually the same here. Obviously you will check, and the cost of goods sold available for sale is 16,500. We can base on the cost of goods sold here. If we minus a 2, we'll come up with 3,400. That's how you check to see if you have the accurate number. So this is the FIFO method. Weighted average method is taking the average of all the goods and take that as the price of all the units. Let's see on hand at start there are 40 units and each of them costs 62. Total cost is 2,480. Then we first purchase, second purchase, third purchase. So again, it's the same what we were doing. 60 times 65 is 3,900. 80 times 67 is 5,360. 70 times 68 is 4,760. So altogether, when we add them up, is 16,500. Number of units available for sale is 250. So if we take 16,500 divided by 250, so on average, each of the unit is costing 66. And we know that hand there end of period there are 50 of the product left. So you know that we have sold 200. Now that we know that we're 50, cost of goods sold is 200. And then on average is $66. So we know the cost of goods sold is 13,200. Ending inventory is 50 unit. So 50 times 66 equals to 3,300. So the advantage of the weighted average method is that it is very simple. It's probably by far the least complicated method. The next method we're going to learn is called LIFO, last in, first out. And inflation-heavy business companies may tend to use it. Assumes that the sales in the period were made from the most recently purchased goods. Earliest goods purchased remain in the inventory. The physical movement of goods in some businesses actually last in, first out. Match the most current cost of items purchased against the current sales revenue. The result is that you'll have a lower net income, lower tax, and because the price is rising. In the real world, FIFO is more popular than LIFO. So, so it depends on the situation of the business when they choose any of these methods. So here it is, we see that, again, we have the column here is the cost of goods sold, okay? And then same conditions, 62, first purchase, second purchase, and third purchase. So the total is 13,370. We know that there are 50 left. And so we applied it to actually the earliest unit. 40 is 62 per unit. So we take the oldest price. And then 10, we took 65. So together is 2,480 plus 650. So therefore it's 3,130. So that will be the ending inventory. So with cost of goods sold available for sale is 16,500 minus the ending inventory from here, we'll get the cost of goods sold is 13,370. Here is that you can also do the calculation by cost of goods sold available for sale. You start with 16,500. You minus the cost of goods sold, which is 13,370, and the ending inventory is 3,130. So this is the LIFO inventory method. Physical flow and cost flow. You'll find that when we count the inventory, we're not just counting the unit. We also have to look at how the costs or the cash flow are flowing. Only the specific identification method will necessarily reflect the cost flow that match the physical flow. For FIFO, weighted average and LIFO are not the exactly identical cost flow. So the physical movement of the goods do not actually reflect the cost flow. And any one of these methods could be used under any set of physical flow conditions. Comparison of inventory methods. Goods available for sale is the same for all the four methods. Ending inventory and cost of goods sold are different. And the gross profit will differ as well. When prices are rising, FIFO result in a largest gross profit. LIFO results in the smallest gross profit because it creates a smallest, therefore it creates the smallest tax liability. In a moment, we will show you the numbers here. When selecting the inventory method to be used by a business, you always remember a few things is that, well, what's your tax? You must, once you pick one, FIFO or LIFO or weighted average, you have to keep the same one. And the physical flow of the inventory does not match the flow assumed by the inventory method. Okay, so the consistency is very important. So before you start reporting, you must determine what method you're going to use. Here it is the comparison of the inventory. As the previous slides talk about, you can see that, look at the gross profit here, okay? How we get the gross profit is sales. And this is total sales, is the same. Okay, the beginning inventory is the same. Purchases is the same. Goods available for sold is the same. But because the ending inventory is different under each of these methods, so therefore the gross profit is different. You can see that the highest gross profit is under FIFO, and the lowest gross profit is under LIFO. And then the specific identification and the weighted average are in between. Now we have covered the periodic inventory system. Let's move on and talk about the perpetual inventory system. It is a continuous record. So kind of like you update it all the time. And this can be done because now with a computerized system. So it's possible. So the balance of the merchandise inventory account at any time shows the cost of goods sold that should be on hand. So kind of it's constantly you are counting how much left and how much is being sold. We use a controlling account, which is merchandise inventory. And this is a subsidiary ledger that is maintained throughout, and we constantly use it. Goods sold usually are assigned a cost on either FIFO, average, or LIFO. Here is a graph to show that you can see that every single of the items are updated whenever there is a sale, whenever there is a new purchase. So it's constantly updating it. Conservation principle. When companies are in doubt, typically there is a principle that most companies follow, is that you tend to lower your asset value and net income measure, meaning that you try to be conservative. You don't want to exaggerate gains, but you always want to account for losses, because nobody wants to have unpleasant surprise. Pleasant surprise is fine. They expect to make certain amount of money, but then the profit turned out to be much higher. That's good. But we don't want surprises that you expect certain amount of profit, but it turns out to be actually not as much. So therefore, you always make sure that you record the loss, but when gain is there, you may not actually record the gain. Lower, therefore, there's a principle using is that either is the lower of cost or the market value. Sometimes it's that the value of inventory changes. It may goes up, it may comes down. So when a situation like that, so what should you do? Should it be the market value? Should it be on the higher value or the lower value? The purpose here is that you always mark either the market value or lower cost, because if it's a lower price, then you will not exaggerate your inventory. Your inventory will not be overstated. Cost means the dollar amount calculated for buying the product, and market is what is the current market value. Okay, so we can see here. Let's give the examples of 3 situations. The first one is that the company bought this item for $8,000, but by now, the end of the period, the market value has dropped down to $7,000 because of the because the companies want to be more conservative in terms of their recording, so it will take 7,000. Recorded purchase cost is 9,000. When you bought it, it was 9,000, but then items went up, it became more expensive. But you can see that being conservative, you would take 9,000 instead of 10,000. Recording purchase of 7,000, and now the price have actually come down to 65, then you always take the lower one. So it's either the market value, which is here, the market value, or lower, whichever that is lower. There are 2 ways to calculate the lower of cost or market. Apply to the total inventory. You can apply to all the inventory you have, or you can apply to each item individually. Okay, so when there is a reduction in the value of inventory, it becomes an expense. Okay, here is it. You can see that loss on write down of inventory. So it's 500, and then merchandise inventory comes down to 500. The last things we're going to learn for this chapter is estimating ending inventory. Now, in some occasion, the inventory basically is estimated because there's certain businesses that it's kind of impossible to count every single items. And estimating inventory is not a problem. It is quite a common practice in the business world using the perpetual inventory method. Unverified amounts are generally reliable estimates if there are numbers for the financial statements that you can use. And businesses using periodic inventory method must use other methods to estimate ending inventory and cost of goods sold. But 2 generally accepted methods is the gross profit method and the retail inventory method. Let's look into the gross profit method. A business normal gross profit is taking net sales minus cost of goods sold. And we use that to estimate the cost of goods sold and ending inventory. Now, calculation is appropriate only if the normal gross sales, gross profit as a percentage of net sales are pretty stable, meaning that you can use a percentage and pretty much every accounting period is very similar. So here is starting here are the data for this problem. Inventory starting period is 80,000. The net purchase is 70,000. Net sales is the first month. And then normal gross profit as percentage of sales is 40%. So let's follow the calculation. First is that we compute the cost of goods sold available for sale. Cost of goods sold available for sales, meaning that inventory in the beginning of the period plus any purchases. So we see that start with 80,000 and new purchase is 70,000. So together, cost of goods sold available is 150,000. Now that we know that is cost of goods sold available for sale, we can move to the next stage. Estimate the cost of goods sold by deducting the normal gross profit from net sales. We know the net sales is 110,000, and we know that the percentage is around 40% of net sales. So therefore, cost of goods sold, if you take 110,000 times 40%, it comes to 44,000. So we know that the estimated cost of goods sold is 158 is 110,000 is 100 and is cost of goods sold minus the 66,000, and then it's the estimated is the end of inventory. I'm confused myself. Okay, let's try again. Cost of goods sold for sale is 150,000. So we know that the cost of goods sold is estimated cost of goods sold is 66,000. There you go. Estimates the cost of goods sold is 66,000. We took 150,000 minus 66,000, that becomes 84,000. So basically we're using net sales, the percentage of it, to estimate the cost of goods sold. With the cost of goods sold, got goods available and the cost of goods sold, we will get the ending inventory. So we use the percentage of it. Used by many retail business. This is called the retail method. On this column is the cost. So how much the company bought the products for. So inventory, they bought it for 60,000, the beginning batch, and then later there's a net purchase of 126,000. So altogether, goods available for sales is 186,000. Now here is retail, is the retail price of these items. So with this first batch of product, they are going to sell it for 85,000. With the net purchase is they're going to sell it at 163,000. So these are the goods that are available for sale, and then these are the price that they're going to ask for. Net sales for the period, okay, these are the net sales. Inventory at the end of the period, that's the inventory. And then we know that the ratio of cost to retail price is 75%. You take 186,000 divided by 248. So you know that it's about 75%. So with the inventory of 68,000, you times it by 75%, So we got 51,000. And so this is the end of period inventory. So again, is very much similar to the other method that you use the percentage to estimate it. And the estimated cost of goods sold is 135,000. How you get it is 180,000 times 75%. So that becomes 150,000. So this is the retail inventory method. It's a bit, it's not complicated. It's you just have to follow the steps one after another, and it's not hard for you to be confused. So the best is that try to do as many exercises as possible. Follow the textbook. The textbook is actually very useful. When you got stuck, go back to read the explanation of each of them and follow the flow and follow the ending inventory. The more you practice, the better you will be. So this is the end of chapter 13.